Hey everybody. So, another big down day in the stock market today. Down over 500 points. Yesterday, down over 800 points in the Dow. The S&P, the total correction from high to low has been about 7.2% based on the close of today. All right. I just went back and I checked the correction that we had in January. And that was, I believe, an 11 point something percent correction. The correction we had in January, then the market ran up to a new high, which we recently had, and now we are in a 7% correction. And I do believe that this is a correction, not the beginning of a bear market, not the beginning. By the way, what is a bear market? I mean, they have ridiculous definitions, if you want to call it that, of a bear market. You always hear people say, oh, when the market's 20% down, that starts a bear market. I don't know anybody who ever made any money selling 20% down. If that's been your strategy over the years, selling 20% down, then, I mean, you really have to have your head examined. That is a crazy, ridiculous, nonsensical strategy, and I don't know who came up with that definition of a bear market. 20% down. Oh, first, now you have to begin selling? Folks, this is about buying low and selling high. Whoever came up with the idea of calling a bear market when the market is already 20% down and then you're supposed to sell, that is just a ridiculous idea. So I'm saying this is a correction. There is no threat that I could see right now to the broader economy. The one thing, or the main thing that I look at, are the fiscal flows, that is the level of spending. As you know, we finished fiscal year 2018 with a record, and I told you that we were going to hit a record level of spending very early on. I mean, right at the very early beginning of fiscal year 2018, a year ago. And we did. We exceeded it by a large margin. And we are already up in the first few days of the new fiscal year. We are already up over last year. It's a little early to discern any exact trend, but we're going to be higher this year. So that's the thing. That's like the tide that floats all boats. I mean, that, if you go back to 2009, and one thing that has really baffled so many economists and market analysts is the length, the duration of this economic expansion. But I have said here before that it's very easy to understand, because starting in 2009 with the Obama stimulus, which had been the high water mark in terms of government spending, 4.586 trillion. By the way, we finished this last fiscal year that concluded on September 30th with 4.71 trillion. We've been over at 4 trillion every single year since 2009. And apparently that's enough spending to keep the economy in an expansion. Now, prior to 2009, the government spent 2.6, 2.7, 2.8 trillion annually, going back many, many years. That was kind of a consistent number. And then all of a sudden it bumped up to well over 4 trillion. Every single year, 2009, 10, 11, 12, 13, 14, 15, 16, 17, and 18 now. And that's what's kept the economy on an expansion. I like to use the analogy of the swimming pool. The government is the giant pump pumping in the water to the swimming pool, and it just keeps filling it up and filling it up. And while there is drainage in the pool, there's leaks for taxation, leaks for spending. The amount flowing in exceeds the leaks, and that's what we call the deficit. I mean, the government is spending more than it is taking away. Now, on that point, it's very interesting because I hear a lot of people, and I guess you would call them smart people. They're not smart to me. I mean, they're again in this kind of primitive mentality where their understanding of economics and the monetary system almost classifies as a kind of mythology or religion. It's just a belief system. It's not based on anything. But they look at the deficit as a negative. And I hear a lot of people now pointing to the deficit saying, aha, that's the reason we're going down. The deficit has been the reason that we are going up. I mean, if the government spends more than it takes away from us, that leaves a net surplus with us in dollar terms. So when I look at that, because all the time when a move happens, I try to listen to the explanations, the rationale, and see how truthful they are, how true they are. Same thing with the dollar. Okay, when the dollar was going up, and by the way, the dollar was weak today, gold had a very, very good rally over about $35 up. When the dollar was going up, the arguments were pretty much always the same. It was about interest rates. Meanwhile, we had, prior to this, the most recent interest rate hike, we had 7 interest rate hikes and the dollar was lower. We had 7 interest rate hikes and gold was higher. So those reasons that were put forth, they're not true. It's just not true. You had 7 rate hikes beginning in December, starting from December 2015. You just had an 8th one. If you look at the dollar index, it is lower now than where it was when it began, when the Fed began raising interest rates. Same thing with gold. Even with the big correction that we had in gold, after 7 rate hikes, it's still higher than where it was. So, I mean, you got to throw that out as an argument because they kept using that as the argument, but it's completely inapplicable as a reason. So you had that. You had the dollar shortage, right? There is no dollar shortage. There is no dollar shortage. You see money supply growth expanding. Okay, yes, the Fed has brought down reserve balances, but the amount of decline in reserve balances is a lot less than the amount of additional spending that we had. So far more spending went in than the amount drawn out by the Fed in terms of reserve balances coming down. So that was not a reason either. There is no dollar shortage. And we didn't see it in any of the Fed. The Fed has these central bank liquidity swaps that it conducts with other central banks when there is tightness or shortages of dollars in foreign banking systems. The Fed will supply the dollars. We saw that happen to an enormous degree in 2008. At the Fed, that was the largest asset on the Fed's books, were these central bank liquidity swaps that ballooned up to almost $600 billion at the time. They're nothing now. There's 70 million. That is, in central bank terms, that is a negligible amount. So there was no stress, there was no tightness, there's no dollar shortage. Now, the same thing applies here when you listen to the rationale or the explanations or the reasons for the sell-off. Interest rates, well, again, we had 8 interest rates and the stock market is higher. Economic numbers are stronger. The deficit, that is constantly being raised as an excuse or a reason for this. It's not correct. It's not correct. By any understanding of the deficit, that is a net addition to the financial balances of the non-governmental sector. That's filling up the swimming pool. That's putting money in our pockets, maybe not equally, but in the economy as a whole. So none of those reasons apply. So this is a correction. Now, if I saw spending suddenly start to come down dramatically, then I would say, yeah, we're going into a recession. No question about it. But that doesn't happen all by itself. That's a political decision. Congress has to come together. They have to come up with a new budget. They have to cut certain things. And don't forget, the largest items of expenditure, they're non-discretionary. They happen no matter what. You're talking about Social Security. You're talking about Medicare. You're talking about Medicaid. And increasingly, for the United States, you're talking about defense spending and spending on wars. That's constantly going up. You just had a gigantic increase in the military budget last year and some more even this year. So those things are non-discretionary. They just keep going up, and those are the biggest items. So the pump is going full blast, and it's even speeding up this year. Now, we have the midterm elections coming up. Maybe there's going to be some changes, and that might spook the market. But if it spooks the market and no policy change, that's just another great buying opportunity. If there is a change in control of Congress, and it looks like now the Democrats are going to win the House, and they're able to pass new legislation which brings down the deficit, then it's done. It's done, and I would agree with anyone who's bearish on here, then it's done. But until that happens, it is not done. So, and by the way, as a little aside here or off topic, oil, I sent out the EIA weekly petroleum analysis that I do. Very important, as I say. The zombies all sold oil today because they saw the build in crude inventories, and last night we saw a very big build in crude inventories in the APIs. But there are things in that report today, and again, I've said this so many times, you can't just look at inventories. That report has a lot of information in there covering demand, covering production, covering imports, covering exports. You got to be able to synthesize all that information, which is what I do. If you want a copy of that report, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of either MMT Trader or Zombie Trading, my Forex signal service. That's it for today, everybody. Let's see what happens tomorrow. Have a great evening. Bye-bye.